Welcome to Ben80 Finances and our video on how to invest in stocks for beginners. In this video, we'll be covering the basics of stock investing, including what stocks are, how to buy them, and how to build a diversified portfolio. We'll also dive into the differences between cumulative and non-cumulative stocks, ETFs, and mutual funds. Finally, we'll talk about the eighth wonder of the world, compound interest, and how it can help you grow your wealth over time. Part 1: What are stocks? Stocks represent ownership in a company, giving you the right to a portion of its earnings and assets. There are two types of stocks, common and preferred. Common stocks are the most widely traded and offer voting rights in the company, while preferred stocks offer a fixed dividend but no voting rights. It's important to understand the difference between these two types of stocks when investing. Part 2: Buying and selling stocks. To buy and sell stocks, you'll need to open a brokerage account. You can do this online or in person. Once you have an account, you can start buying and selling stocks. However, it's important to do your research before investing in any stock. This includes looking at the company's financials, competitive landscape, and industry trends. You can use financial statements like the income statement, balance sheet, and cash flow statement to evaluate the financial health of a company. Part 3: ETFs and mutual funds. ETFs and mutual funds are popular investment options for those looking to build a diversified portfolio. ETFs are like baskets of stocks that track a particular index, such as the S&P 500. They trade on an exchange like a stock, and their value fluctuates throughout the day. Mutual funds are similar to ETFs in that they are also baskets of stocks, but they are actively managed by a professional fund manager who makes investment decisions on behalf of the investors. They are priced once a day after the market closes. Part 4: Cumulative and non-cumulative stocks. Cumulative and non-cumulative stocks refer to how dividends are paid out to shareholders. With cumulative stocks, if the company skips a dividend payment, they owe that payment to shareholders and must pay it out at a later date. With non-cumulative stocks, if the company skips a dividend payment, they do not owe it to shareholders. It's important to understand this distinction when investing in dividend-paying stocks. Part 5: Compound interest. Compound interest is often referred to as the eighth wonder of the world, and for good reason. It's the process by which interest is earned not only on the principal investment, but also on the interest that has been previously earned. For example, if you invest $1,000 at a 5% annual interest rate, after 1 year, you would earn $50 in interest, bringing your total balance to $1,050. If you continue to leave that money invested and earn another 5% the next year, you would earn $52.50 in interest, bringing your total balance to $1,102.50. Over time, compound interest can help your investments grow exponentially. Now, let's talk about mutual funds and ETFs more deeply, which are two popular investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Mutual funds are professionally managed by a fund manager who invests the money in a variety of assets, with the aim of achieving a specific investment objective. Mutual funds can be actively managed, where the fund manager makes decisions about which assets to buy and sell based on their research and market analysis. Alternatively, they can be passively managed, where the fund tracks the performance of a specific market index, such as the S&P 500. Mutual funds can be a great option for beginners because they offer diversification and are easy to invest in. They can also be a good option for those who don't have the time or expertise to research individual stocks. ETFs are similar to mutual funds in that they pool money from many investors to purchase a diversified portfolio of assets. However, ETFs trade like individual stocks on an exchange, which means their prices fluctuate throughout the day. ETFs are often cheaper to invest in than mutual funds, and they can be a good option for those who want to invest in a specific sector or index. Now, let's discuss the difference between cumulative and non-cumulative stocks. Cumulative stocks pay a fixed dividend that accumulates if it is not paid out in a particular year. This means that if a company does not pay a dividend in a particular year, the dividend payment will accumulate and be paid out in the future. Non-cumulative stocks do not accumulate unpaid dividends, so if a company decides not to pay a dividend in a particular year, the shareholders will not receive a payment. Finally, let's talk about the eighth wonder of the world, compound interest. Compound interest is the interest earned on the initial investment as well as the interest earned on that interest. This means that over time, the investment grows at an increasing rate, which can lead to significant returns over the long term. For example, if you invest $1,000 with a 5% annual interest rate, after 1 year, you will have $1,050. If you reinvest the interest and earn another 5% the following year, you will have $1,102.50 at the end of year 2. Over time, the power of compounding can help your investments grow exponentially. In conclusion, investing in stocks can be a great way to grow your wealth over the long term. By understanding the basics of stock investing, including the different types of stocks, mutual funds, and ETFs, as well as the power of compound interest, you can make informed decisions about your investments and work towards achieving your financial goals. When it comes to investing in stocks, it's important to do your research and understand the risks involved. Here are some additional tips to keep in mind. Diversify your portfolio. Investing in a variety of stocks can help reduce risk and increase potential returns. Invest for the long term. Investing is not a get-rich-quick scheme. Instead, it's a long-term strategy for building wealth. Try to avoid reacting to short-term market fluctuations and focus on your long-term goals. Keep an eye on fees. Investing in mutual funds or ETFs can come with fees, such as expense ratios or transaction fees. Be sure to understand the fees you're paying and how they can impact your returns over time. Consider working with a financial advisor. A financial advisor can help you create a personalized investment plan and provide guidance on how to reach your financial goals. Stay up to date with market news. Keeping up with the latest market news and trends can help you make informed investment decisions. Remember, investing in stocks is just one part of a larger financial plan. It's important to also focus on managing your expenses, building an emergency fund, and paying off any high-interest debt. By following these tips and understanding the basics of stock investing, you can work towards achieving your financial goals and securing your financial future.